Welcome to the daily insights that matter. The net household financial savings have fallen to a 3-year low of 4% of the GDP in the first half of FY23 from a 7.3% in FY 2022. Now, this indicates that the savings were used extensively to support consumption. Now, consumption and savings are two sides of the same coin, and they go hand in hand. Now, usually high inflation results in weakening consumption, but this time high inflation in India was clubbed with consumption growth remaining robust. Now, the private final consumption expenditure has remained extremely strong, posting a 29% year-on-year growth in the first half of FY23, following a 17% growth seen in FY 2022. Now, the private final consumption expenditure also increased to a two-decade high of 61.4% of the GDP. Now, this was fueled by pent-up demand and the K-shaped recovery, which eventually led to the household financial savings dropping drastically. Household net financial savings were around 5.2 lakh crores in the first half of FY23 when compared to 17.2 lakh crores in all of FY 2022. Now, while bank deposits grew at a tepid rate, household debt went up sharply in the first half of FY23 as households borrowed more to spend. Now, household savings in India has two components. First is the financial and second is the physical savings. While financial household savings account for 35 to 40% of the total household savings, physical savings account for 60% of the household savings. Now, an analysis of one component of the household savings could be misleading. Now, in a stark contrast to the financial household savings, physical household savings continued its robust trend and stayed broadly unchanged at 11.7% of the GDP in the first half of FY23. Now, with a sharp fall in the financial household savings but unchanged physical household savings, the total household savings declined to 15.7% of the GDP in the first half of FY23 as against the levels of about 20% of GDP seen in the last 5 years. Now, although the share of the private consumption in GDP is in line with the first advance estimates for FY23, it is expected to be much lower for the full year than for the first half of the year. Now, as pent-up demand fades and as lower external demand starts affecting incomes, consumption will be expected to come down and savings will start to normalize. Now, other factors for weak consumption up ahead would be a slowdown in new hiring, high inflation affecting consumption patterns, increasing mortgage EMIs, etc. FIIs, or foreign institutional investors, have sold over $1 billion in local equities in the first 8 sessions of this calendar year, which is 2023. While the first trading session of the new year witnessed inflows of $201 million, the next 9 sessions of 2023 saw withdrawals to the tune of $1.21 billion. Hence, the net outflows have been $1.01 billion as of January 11th. Now, barring auto, the sell-off was seen across sectors with the volatility index, India VIX, surging over 6%. Banks, financials, and IT companies were amongst the worst hit sectors in this week. Now, the trading sentiment has been extremely weak and the key indices have corrected by almost 1% in the first week of 2023. Now, some of the factors behind the sell-off are the Fed fear, the hawkish comments from 2 US Fed officials ahead of the important US inflation figures has sent jitters across the FIIs. Now, the FIIs are also looking to chase lower valuations. With the Chinese economy opening up, the money taken out by the FIIs is being invested in the underperformers of last years like China and Europe, thus indicating that the FIIs are clearly chasing lower valuations. The ongoing Russia-Ukraine crisis is having an influence on the commodity prices, which is leading for another sell-off. All eyes are on the union budget. The biggest worry remains on the current account deficit. Sharp slowdown in exports coupled with higher imports have worsened the current account balance. Now, significant consumption slowdown post the festive season is another worry for the economy, and hence the union budget will be a major event driving the market sentiments. The FII flows have remained volatile for the most part of this fiscal year. While FIIs sold heavily, DIIs and retail investors absorbed the selling to a large extent and made big profits when the markets recovered. Now, having said that, despite global macroeconomic concerns, India's inflation is well controlled and its growth trends may continue to be resilient. The important factors to watch for in 2023 would be the sustainability of credit growth, equity inflows, and robust corporate earnings momentums. Corporate earnings of the Nifty are expected to grow by 15% and 13% in FY24 and FY25 respectively, and hence these trends should continue going forward. So what does all of this news mean for you? The decline in household net financial savings and thus the total household savings is temporary and will revert back towards 7 to 8% of the GDP over the next few quarters. However, this means that consumption growth will ease once again, resulting in slower growth in the economic activity. This will therefore have an indirect neutral impact on you. Now, despite India being amongst the world's best performing equity market in 2022, FIIs were volatile then and they will continue to remain volatile in 2023 on the back of global macroeconomic developments. However, it is important to note that this is a short-term challenge and this can also turn out to be an opportunity for long-term investors. Hence, this will have a direct neutral impact on you. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.